fairly significantly in overnight trading as well. So a lot of things to keep track of, and of course always got to listen closely and keep an eye on Truth Social. Never know what's coming. We're back after this. All right, there's an important barometer, of course. We talked a lot about the bond market earlier this week. It may have certainly been one of the reasons why the White House did backtrack in terms of at least suspending for 90 days the draconian, some would say, tariffs, reverting to 10% across the board. But it's headed back towards 4.5%. Certainly something we're going to keep an eye on. I know Jim doesn't like to talk about the basis trade, but that's part, it's all, who knows? I don't know who's selling, Jim. I don't know. It doesn't appear the Chinese have started selling yet.
No, there's a lot of things underneath that are wrong,
but
including
the real question is, do you need to pay a risk premium for what was a riskless asset?
Well put.
Thank you. All right, he's got his mad dash. He's getting ready for that. We got an opening bell 10 minutes away. Also ahead, of course, we're going to have Larry Fink right here talking, well, everything, including BlackRock's earnings, of course, and the current state of the economy. Don't go anywhere.
make money.
All right, we got a Friday version of the Mad Dash. It's going to be very similar to our other Mad Dashes, of course. We're talking about a significant turnaround in futures. We're heading now into what would be a lower open.
Yes.
Who knows if we're going to retest the lows,
Well,
Jim,
I was
that we
surprised
saw.
it was up at all. There's nothing positive that I'm seeing other than when the bank executives
But
are all
the
being...
bank earnings
but they
were
themselves-
strong.
Yes, but they themselves are saying going forward, we're not sure. Now, honestly, David,
What do you want to
it's
do for the Mad
Friday.
Dash? Yeah.
I'm putting together a list every day of the companies that are now, I'm calling the anointed company. You can call them the sainted companies. These are the companies that are what you have to buy here. And David, one that I think you and I are both kind of in awe is the turnaround of Verizon. Today, Evercore upgrades it. Look at this. This is Verizon.
Yeah.
This is not NVIDIA.
No.
This is Verizon.
Verizon.
And it's a taker of these products. Not, what's the matter?
Nothing. I got like schmutz on my face.
Well,
yeah,
do
sorry.
something about it after.
All right, I'm sorry.
What are you wearing? The New Balance?
Yeah,
I mean,
I'm wearing the New Balance.
New Balance.
It's Friday. I don't wear a
Nike's
tie.
falling through the. You
I
got
wear
to help
sneakers.
Nike.
I can't get my leg up that high.
All right, that's terrific. I'm glad you went over that.
All right,
with your
Verizon
research.
is a largely
But-
domestic company that's a beneficiary of the current
Right.
environment, right?
Fiber efforts not getting enough credit. So we're sitting here with AT&T and Verizon being winners, United Health, Humana being winners, maybe Centene being a winner, McKesson being a winner, Cencora being a winner. Well, there you go, David.
All right, I want to come back. I want to come back to Apple.
That's the Navarro portfolio. There, Peter. There's the Navarro portfolio. Yeah, and Samsung.
And Samsung.
And Samsung.
Right. Now, that said, we have to go.
I got to buy Huawei, man. They're the big winner. What a backfire.
Okay. We've got to get ready for Larry Fink, of course. We got an opening bell 5 minutes from now. Don't go anywhere. All right, we got Tesla moving lower again in the pre-market. Just to get to that, Reuters reporting the company has suspended taking new orders for Model S, Model X vehicles on its Chinese website. These both are models made in the U.S., so they're imported to China. Yeah, you're not going to be selling any of those.
No.
Not a one.
No, that's it. Well,
No.
It's a trade embargo. We're no longer the two countries talking to each other. We need a little bit of perspective of someone who understands international markets. I think we should have Larry Fink brought in right now.
Right now? But
Right now.
I think. All right. Really?
He's here.
We're going to get interrupted by an opening bell, Larry.
Yeah,
so that'll be in 50 seconds.
Okay.
So I'll let you think. You can answer this a little bit, and then we can come back to it. Are
Right.
we going to have a recession in the United States?
As I said on Monday at a talk that I gave at the New York Economic Club, I think we're very close, if not in a recession now. What may be
You don't need that.
good. What may be happening is a lot of people are buying in advance of the elevated increases, like lines around Apple stores buying iPhones and
Yes.
all that stuff. But I believe all the uncertainty is really making everyone pause. And everyone's waiting and seeing. And so I think you're going to see this across the board. We just say slow down until we have more certainty.
Yeah.
And, we now have a 90-day pause on the reciprocal tariff. That means longer, more elevated uncertainty.
Speaking of pauses, let's take a quick pause. Let's get the opening bell. We'll be right back to Larry for a conversation. Here at the big board, we've got Project Code. That's a Chicago-based nonprofit aiming to reduce violence, build economic opportunity at the NASDAQ, the online pet pharmacy, Pet Meds. There's something you want to buy. Dog gets sick, man. You got trouble.
No doubt about it.
No doubt about it. All right, Larry, let's continue. I know we got a little bit of background noise here, but you're making the point. You obviously talked about this. Listen, we were talking about it, the uncertainty. So many CEOs we're speaking to. I've heard this now many number of times, similar to early days of COVID, like 5 years ago.
Sure.
I just don't know what's coming. I have nothing to expect, and so I'm keeping my head down. Is that a fair way to sort of characterize it?
I think that's a bad answer because today you need to run into the uncertainty and try to find solutions.
Okay.
So keeping your head down, I would not like that as an answer as a shareholder with any CEO.
Right.
I mean, to me, this is an opportunity to look for opportunities. And because of all our clients having uncertainty, we are spending more time with more conversation with more clients globally than any time. Our job now is to be, helping, calming, giving them ideas. So if a CEO said, I'm going to keep my head down.
Well, I guess that was one the way one characterized it. But I guess it's the uncertainty itself that creates an inability to do long-term planning in terms of capital allocation.
There's
right
no
now.
question CapEx is falling right now until you have better understanding where should that CapEx go. But I do believe, as I said in my talk this morning,
yes.
I do believe the mega trends are still with us, whether it's AI, data centers, infrastructure, the whole reorientation of our economy. So I think the mega force trends are not going to change by what is happening now. But maybe the execution of some of these trends may be delayed, may be pushed out longer. But I still remain to be optimistic over the long run. Yes, we have to recalibrate. Yes, I do believe we're probably starting, if not, we're in a recession. Yes, I think the market is still underestimating how high inflation can get. If you factor in all the tariffs,
Right.
you factor in all these other issues, it's going to be quite additive. I mean, I read in a report that if you just take the tariffs in the cost of home building, the average new home could be up as much as 26%. We already have a housing affordability problem.
None of this sounds any good to me, Larry. I mean, and it's all self-inflicted, by the way. None of it needed to
This
happen.
is not a pandemic. This is not a financial crisis. This is something that we've created. As I said also on Monday, the United States post-World War II was a global stabilizer. We are the global destabilizer.
Right.
Now,
And
Larry,
that's a very hard thing to say because I pride ourselves of being, bringing the leadership, bringing the conversations. But I will say the power of U.S. capitalism is still alive. I will say more and more times clients worldwide are asking for our, at least at the CEO level, they're asking for our vision, our views. They still want to engage. They still want to build. So I'm less. Long term, I'm less worried about some of these issues, but in the short run, I'm petrified at some of these issues.
Petrified.
Well,
What
let's speak of being petrified. You and I are old enough to remember when Nixon went to China, opened the door,
or the gold, or walking away from the gold standard.
Right, the same couple of years. And I think that there was tremendous anxiety then going the other way. Did we really think that we could have a great relationship with Mao, who was a mass murderer? Did we think that we could actually do business with China? We did $1 billion with them the next year, but then next thing we know, we're doing $100 billion. Now we're doing $438 billion, and now we want to do zero. How does zero impact our country?
Well, we've had now 20 plus years of supply chain creations, and another economic force, Jim, post World War II was consumerism. So we built the whole foundation of economic policy around consumerism, providing Americans with the cheapest products. Right. And so that was the foundation. Now, did that come at a cost that some of our communities were decimated, where they lost jobs? Absolutely. So maybe we went too far on the whole concept of consumerism. But let's be clear, the major economic foundation was based on consumerism. And so we wanted our companies to go around the world to find the best places to provide the highest quality at the cheapest prices, so we could consume more. And we always thought that type of consumption was the most progressive form of economic behavior. More people could have more, and that was one of the fundamental reasons why the United States was the leader. Yes, because our citizens were huge consumers. By now changing this equilibrium, it's going to be harder to consume, and we're going to have elevated inflation.
Can we afford to have no relations with China? Do we have to have a dialogue?
One of my asymmetric views is we will have a strong relationship with China, one form or another. I do believe we do need a trading agreement with China. I hope there's a future where we have conversation with China, where China agrees to buy $100 billion of our agriculture to help our farmers. I hope there's a future where China agrees to buy a large portion of their LNG with U.S. producers. So there are opportunities, and I know right at this time there's no conversation or little conversation. I know the whole issue that's going around it, but I am hopeful that we are going to have conversation with China that will hopefully allow us to have relationships, that there is business. That being said, we are still going to have tensions related to technology. We are going to have to making sure that it's U.S. technology that's going to be diffusing technology, especially for AI. Right. It should be U.S. technology that is connecting the world, not Chinese technology.
Well, and you guys have been very involved in financing some of that build out, of course, being a key partner, for example, in the build out of the AI infrastructure in terms of data centers and everything else.
And obviously not worry about the peak in data center that Wall Street's so fixated.
There is no peak.
There's no
In fact, the capex that's necessary to do that is only going to grow. As we democratize AI, we need more data centers because the utilization will be greater. So this is
it is, but the costs are going to go up, aren't they? Conceivably, for the servers that go into a data center.
Right now, a 1 gigawatt data center with all the GPUs, all the power, all that, we're talking $50 billion per data center.
Right.
We're talking major, but data centers don't throw off a big return. So a data center throws off, even with leverage, because at 11 or 14% return.
But that's fine for you're happy to finance that all day long.
But that's the beauty of our capital markets. Microsoft trades at a much higher PE.
Right.
Owning data center degrades their PE. Same thing with.
They don't want to. They'd much rather have you and pay you, and they're a great
credit. Our capital markets.
All
and that's
understood.
Why I'm so bullish.
But does it? This has been the most important thing we've been talking about for the last year and a half, 2 years. Has been driving a lot of our certainly our equity markets. Do we slow down our advances as a result of some of these tariffs that are in place right now?
We better not, because China's not slowing down in their technology.
Okay.
It's Sputnik. We need the competition to be great.
Competition is good.
They are not slowing down at all.
We're not, and they're building 100 gigawatts of power right now using nuclear. So they're going to have the power generation to do AI. This is one of my calls of action. We need to be forceful in building out our infrastructure that we have the power generation so we can do these.
But I want to get to a lot of other subjects, but you see no slowdown at this point at all in terms of the spending by the hyperscalers and the others who would be customers of the data centers that you get behind.
There certainly could be one quarter or 2 quarters, but everything that we see in the plans, in their long-term plans, is to build this out as fast as possible.
I'm going to be pedestrian for 1 second.
Yeah.
My travel trust has a huge position in your stock. I thought that your organic growth was better than expected.
It was.
And look, the flows in are still good. The technology's great. Lost in the whole shuffle, your stock has come down a lot, and to me represents value.
I think our stock represents incredible value. We had our best beginning of the year in 6 years. We had 14% technology growth in the quarter. We had, if you take out the one client who took out some low fee index business, we had $140 billion of flows. We actually, in a period of time where most people lost assets and equities, we had equity increases. Our systematic equity team, our Aperio team, we had positive flows. So we had an incredible quarter of flows, and we had a 6% net fee growth, which I think the street estimate was 3 or 4.
Much better.
So
yeah,
we had in almost every category a beat across the board.
Larry, I got to ask you about the 10-year, about the fixed income markets overall.
Yes.
We're watching; it's now above 4.5% again. I've been saying that is there now a risk premium on what had been viewed as a riskless asset? What do you make of this move recently, which, by all arguments, should be going the other way, at least given what we're seeing?
I don't agree with that.
Okay, why not?
So, first of all, I was shocked where the 10-year went last Thursday and Friday. Everybody was fixated on recession, but was not fixating at what the cost will be related to the tariffs and how inflation that is. So I actually believe we're going to have much greater embedded inflation in this country. We're already going to have more embedded inflation because we have, despite all this noise and narrative, we have job shortages in almost every industry. Brad Smith from Microsoft said we need 500,000 electricians to do this AI. Okay, we have so many needs in this country, and because we don't have the supply of people, so we're going to have elevated
and wage inflation as well. By the way, so why are we going through all this to create manufacturing jobs when we conceivably have a shortage of electricians already?
And electricians will make more money than what is the starting salary of a United Auto worker today?
100,000.
It's $25 to $30 an hour.
Right.
Starting, it can go up to $45, $50 an hour. But the electricians are closer to $80 an hour.
All right, I don't want to get you back to the bond market because
perfect. So the bond market. I've said this in the last few weeks. I said it again this past Monday. I'm more worried about a much deeper yield curve. And could I see a 5% 10-year? Sure. I don't believe the Federal Reserve will have the ability to do any real easings. I know the forward curves at one time a few days ago was 4 easings, and I said there may not be any easings.
So this is not Chinese selling our bonds or the Japanese or some of our former trading partners and allies selling as much as it's simply a response to an inflationary environment that may be coming?
So you may see selling from those people, but not because it's a reaction to.
I see.
Most central banks who have trade surplus. So let's just talk about Japan for a second. Japan has a big trade surplus with the United States. When we give them dollars to buy their goods,
yes.
That then would
come back and them buying our treasury bonds or investing
So they have to keep their currency stable. So instead of having the excess, they buy treasuries to sterilize any currency movement. If you believe that the tariffs are going to minimize trade surpluses or we don't need them, they don't need to own U.S. treasuries. Okay, and that's a problem. Because 40% and I've said this in the show before, 40% of our deficits are financed by foreigners. Okay, that's when we're worried about manufacturing. overseas? How about our ownership of our own credit markets so large overseas? That is a risk.
Okay.
And it is a big risk. And so I'm not surprised to seeing a deterioration of the dollar, which means dollars are coming back.
All right, Larry, you talk to so many business leaders, probably more than anyone I know. We are seeing some sort of bizarre split. If you're making any manufacturing in China and you're American, you're being discriminated against by this president. Apple, Nike. If you move to Vietnam because that's what you thought in 2016 that the president Trump wanted you to do, moving out of China, you're being incredibly discriminated against. Who is standing up for these great American companies in that White House?
Well, also, more importantly, a lot of our big companies that have great brands overseas are being discriminated.
Yes.
I mean, whether it's a Starbucks selling coffee in a certain, they're going to be buying local coffees and everything else. We have a big image issue right now, and I do believe this is going to be short term. But we have to address all these issues, and it's going to start showing up in earnings, and that's what the stock market is reflective of.
Yeah, well, you said it earlier, and we're going to have to sadly let you go in a moment, Larry, but that you're petrified. That was your word. You used it. And yet you're also offering advice to clients.
But I'm also optimistic.
So what is the advice then? What you're petrified and optimistic.
No, but I'm worried about the short run, and I'm optimistic in the long run. These mega trends haven't changed.
Fair enough.
What are you telling people to do then, or when you're getting
still save?
We saw a $20 billion increase in money markets in the last week.
Yeah.
So we're seeing a lot of. We have $12 trillion in money market. When there is smoke, when there is an understanding of what's going on, money will be put to work.
Smoke is in the papal Vatican.
Right.
They're telling me you have to go,
Smoke,
and it's bugging me. But good luck with the Dodgers.
We could talk to them all day long.
The Dodgers are doing pretty well.
Yes, they are.
Yeah, they certainly are.
And they still play, no matter what happens. They're out there.
And actually, the Dodgers done a very good job of bringing in players from overseas, and that's the power of globalism.
All right, I'll take that as
there you go.
Yes for globalism.
Well, it's good to end on a positive note. Larry, thank you.
Thank you,
Larry.
Of course, Chairman CEO of BlackRock. We do have a rebound in the markets, Jim. The Nasdaq is now up.
Larry came on and talked about how things could be great longer term, and people are going to save, which is really unbelievable. We got to get people to save again. My kids are going to do better than I.
Gosh, I hope that's true.
I agree.
All right. What do you guys want to do now?
David, it's TV. You're never supposed to do that.
Really? Well, I don't know. I mean, Larry's still here.
I'm still here.
I'd love him to just stay. I don't know.
I think I got to do a town hall.
Oh, you got to go do a town
You can
hall?
stay on the couch. You did your thing. You can stay on the couch.
Yeah. You can come anytime, by the way.
Thank you.
You just want to sit and watch.
You know what? Why don't you guys do your show at my office, and I can spend an hour and a half with you.
Perfect.
And we'll meet Aladdin. We'll do everything.
Right.
I like that.
I would love it.
All right, can we go
We'll
do
set
that?
that
And we'll
up.
talk about Bitcoin
All right.
and $3 billion in.
It's closer to your homes too, by the way.
Sure. Yeah, whatever. Everything's a subway right away. All right, Larry, again, thank you.
Larry,
We'll get you out of
thank
here.
you so much.
We, of course, are monitoring many of the bank earnings, as you know, this morning, including J.P. Morgan's, where we did hear from Jamie Dimon as well. This on tariffs and perhaps the impact. Take a listen.
Some of all the issues that are raised existed before the new administration, like the geopolitical situation, the excess fiscal deficits, poorly done regulations, and all of that. Obviously, pro-growth is good, pro-business is good, pro-dereg is good. I think the best thing to do is to allow the Secretary of Treasury and the folks working with him in the administration to finish as quick as possible the agreements that they need to make with around tariffs and with our trading partners. And I think there'll be agreements in principle. They're not going to, trade agreements themselves would be 5,000 or 10,000 pages long. And that's the best way to go about it right now. That does not mean you won't have some of the effects take place anyway.
That was Jamie Dimon. That was kind of constructive. And by the way, speaking of constructive, obviously Larry Fink was petrified but optimistic. And we've got the S&P up 0.5%. I would note J.P. Morgan shares have now surged. We had a brief. We started off with futures.
Do you think I was too negative and that I helped cause some sort of decline?
No, I don't.
Thank you.
No, I don't know that we can have any impact
positive
whatsoever.
and constructive, and I think Charlie Sharp did a great job, and that stock should be higher. Look at this, J.P. Morgan upbeat. These are great American companies too. I want to be constructive. Man, that's a big move.
Well, we now have most of the Mag 7 up. We've got NVIDIA up nicely, even Apple as well, despite
you heard
what we
he said.
discussed
How
of their
about the
significant
Wall Street's
challenges.
Focused on the last 7 days of the data center. He's focused on the next 7 years.
Yes. And I mean, I think we've heard that uniformly during the course of the week in terms of data center spending from obviously the usual suspects, whether they be Alphabet or Amazon or even Microsoft.
I'm getting
to some
NVIDIA
extent.
sold out, but these guys, would say, oh, no, they had a bad 48 hours. I mean, this short-sighted nature of NVIDIA, I want every retail investor who's in NVIDIA to not be shaken out by Wall Street, which is saying, you know what, you got to be very careful about the last 48 hours of NVIDIA.
Right.
That's really the way to play it. I'm constructive.
Well, you can be both petrified and optimistic,
I'm not
Jim.
petrified. Our companies are great.
Yeah, our companies may be great, but they're dealing with a lot of headwinds right now.
Business is the greatest force of social change in this country, and it will not be changed.
All right.
Business is good in this country.
You get no disagreement from me. Let's give you a look at the bond market as well before we take a quick break. Of course, we have been watching treasuries on the 10-year certainly exceeding a 4.5% yield. That currently is still the case. Yields are, 4.49, so we're down a bit. As you see, the 2-year as well at 3.899, and that 30-year a bit below 5% as well. And you heard Larry Fink discussing fixed income. His belief being inflation's coming, and it's really more reflective of that expectation as opposed to any true selling
And do people know how much he runs? He speaks for the average investor. He speaks for Main Street. The president speaks for Main Street. He speaks for Main Street's dollars. And that's why I love him coming on. He's constructive.
We'll be right back.
I'm constructive.
CNBC.
just switched.
All right, that's just 22 minutes in. Obviously includes the futures. You can see we looked lower. We were, and now we're
right now Microsoft just jumped a percent. Jeez,
now we're up
incredible.
0.5%. We're moving nicely this morning.
Did you tweet? Is that what happened?
I rarely, if ever, use that platform, but
you X'd.
we do have a nice move. Obviously, man, Bitcoin and gold though. That's really where
Right.
Gold.
Okay. Buy Newmont mine. Hey, I'll tell you, buy American. Buy a Nickel Eagle. They are buying the gold at Costco. You can't get. I've tried every day this week to get Costco gold, and I haven't been able to get any.
I'm sorry to hear that. All right, get ready for your stop trading. What stock you want to focus on there? Of course,
Oh yeah, I got a good one.
I do have a bit of a rally in the S&P. All right, we got some news from the FDA that's impacting
I don't
the
normally
stock.
do small caps, but there's an FDA announcement plan to phase out animal testing requirement for monoclonal antibodies. By the way, Regeneron, biggest in that. But what they're going to do is you got to do it AI. And the AI company that has it, I've had them on, is Recursion Pharmaceuticals, RX, backed by Jensen Huang and NVIDIA. And they're going to be the winner in how we decide much faster to have drugs approved in this country. It's the first real deregulation I've seen. Congratulations to the people who are trying to deregulate.
Okay.
By the way, Michelle Bowman, I think, is going to be very positive for Wells Fargo, a deregulated Federal Reserve. I think they and the White House have to start shifting the narrative back to dereg.
Yes, that would be helpful.
And stop picking on people who are constructive.
You got it. All right, you have a great day.
Yeah,
okay?
I'll see you later.
I will see you later, for sure. All right, we got a volatile session for stocks, but we are up nicely on both the S&P and the NASDAQ. Don't go anywhere.
now.
Good Friday morning, everyone. Welcome to Squawk on the Street. I'm Sarah Eisen with David Faber and Mike Santoli, live as always from Post 9 of the New York Stock Exchange. Carl's on assignment. What a week. And here we are with the S&P 500 actually higher right now. We've reversed an earlier decline. We're all over the place. The Dow has just dipped negative. It's positive. Can't make up its mind. The NASDAQ is a little bit higher.
Cats and dogs living together. It's just crazy.
It's crazy. And yesterday we saw a big sell-off after the big rebound on Wednesday. We're going to talk about it. I would focus on bonds today. This is the center of the storm right now. And what you're seeing is bonds selling off and yields higher. The 10-year yield is above 4.5%. We've seen a sharply higher move over the last few sessions. The 30-year yield just under 5%. We're going to talk about the why and why a lot of the bond folks that I'm talking to on the desk are getting a little worried about this move.
Yes, for sure. We are 30 minutes into the trading session. Here are some movers that we're watching. Of course, watching China-related names after China retaliated against raised U.S. tariffs with higher levies of its own. We will head live to Beijing for the latest in just a moment, although you see China-linked ETFs and stocks higher on the session. Big currency moves as the dollar slides to fresh lows on the year. Yesterday was the dollar's worst day in 3 years, now hitting a 10-year low against the Swiss franc as well. You see the opposite directions. Dollar and franc have gone on a year-to-date basis. Euro also popping to highs last seen in 2022. On the commodities front, gold remaining a safe haven, almost to the exclusion of everything else, hitting more all-time highs this morning, while oil prices continue to fall. And separately, a number of results out of the big banks this morning. J.P. Morgan, Wells Fargo, Morgan Stanley. We will break down the numbers this hour. J.P. Morgan up 2%, the others backing off.
All right, we also have some economic data that just crossed the tape, and Rick Santelli has that for us. Rick?
Yes, David, these are not pretty numbers on our April preliminary look on University of Michigan sentiment. On the headline number, 50.8. That's 3 points less than we were expecting. That's about 6.5 points under our last look, and that's the weakest since June of 22. 56.5 on current conditions. That's also extremely light, weakest since June of 22. Huge drop in expectations, 47.2. And on the inflation front, 6.7% on one-year inflation. That follows a 5%. That would be the highest since the Thanksgiving of 1981. 4.4 and 5 to 10-year inflation, that would be the highest since the summer of 91. Now, these are, of course, not quantified, but qualified. They're surveys. And we just had good data in CPI yesterday, PPI today. But these are the worst fears, obviously, of those surveyed. And they really do underscore some of the underlying emotion that is in the marketplace to put forth these types of numbers. Right now, we're hovering at 452, 453 on a 10-year. And do keep in mind, it settled at 4% last week, a huge move, although it still hasn't challenged its high-yield close of the year in January. Sarah, back to you.
Okay, Rick, thank you very much. The trade war between the U.S. and China heating up. China striking back with a massive tariff on our exports to China. Eunice Yoon in Beijing with more. Eunice, good morning.
Thanks, Sarah. Well, in 2 hours, China's 125% tariff is going to go into effect on all American products. This is in response to President Trump's 145% tariff, which the Commerce Ministry had described today as abnormally high and a joke. The government argues that at such high levels, Chinese are not going to want to buy American products. So the Commerce Ministry said that if President Trump raises tariffs again, China would ignore what it's calling his numbers game. Now, the focus here is to provide support for Chinese exporters, and it looks as though some of that is not only coming from the government, but also from the private sector. JD said that it's going to buy $27 billion worth of Chinese exports this year to sell into the Chinese market. Alibaba's grocery chain Hema said it would help fast-track exporters to sell into China. And then to diversify markets further on a government government level, the Chinese president, Xi Jinping, had met with the Spanish prime minister here and called on Europe to help China resist, quote, unilateral bullying. And of course, the irony here is that up until recently, the U.S. and Europe have been side by side trying to stop China from what they describe as coercive and unfair trade practices. Guys?
Eunice, do we have any sense? Are we starting to get a sense as to what this is going to mean for the Chinese economy, though? I mean, basically the idling, it would seem, eventually of all manufacturing for goods that are meant or bound for the United States?
Yeah, absolutely. I think it's looking really bad. I mean, we have like a lot of economists saying that this could take a couple percentage points off of the economic growth here just for this year. There's also just anecdotally, just in the past day or so, I've had a number of U.S. companies say that they're not necessarily going to be coming to China for a fair that's supposed to happen next week because of the level of the tariff. Also, they're saying that they've stopped their shipments. So there's definitely going to be an impact, and that's probably the reason why the government, as well as the private sector, is looking to try to support those Chinese exporters as much as they can.
And I would add to that, it's really hard to tell what's going on with the stock market and the bond market and the dollar versus the yuan there because it's also managed. Right, Eunice?
Oh, no, absolutely. It's very difficult. I mean, today we saw the stock market rallying, but in the past couple of days, the state funds had come in, the national team, as it's described, of all these different companies coming in, saying that they're going to announce buyback plans. So, a lot of that is orchestrated, and it's difficult to say exactly, what the impact is going to be.
Okay, thank you very much, Eunice Yoon in Beijing. In the meantime, the reaction to all of this that we're watching in the bond market, because that's where we're seeing sharply higher yields. As Rick said, we're not at the highs of the year yet in terms of the close, but we're moving fast and we're moving up. And you have this sort of triple whammy of selling stocks, selling bonds, selling the U.S. dollar, and that leads to questions about who is unloading U.S. assets. And what we're seeing is there a crisis of confidence and credibility. The U.S. exceptionalism trade has been the trade where it's, bet on the U.S. AI companies, bet on U.S. bond market because it's a riskless asset. All of these things come into question when the U.S. upends the global trading system. I don't want to overplay it, but these are the conversations that I'm having with folks on the desks right now. And I think the big question is there going to be a policy response from the Federal Reserve, from the administration? How bad does it have to get out there in the bond market where you're selling bonds at a time where the market is overall spooked to do this? And when I just spoke to some folks on a bond desk, and they said it's the people you don't want selling. What does that mean? Sovereigns, foreigners, people long money holding, central banks potentially. So how bad does that get?
All right. What are they citing as the reason? I mean, we spoke to Larry Fink earlier. I brought this up with him, of course, and unexpectedly, he seemed to think it was not necessarily a function of that, but as much as inflation expectations and the fact that it's going to be far higher that are behind this move.
Market-based inflation expectations are crashing right now.
Well,
honestly.
And beyond that, I mean, look, and that's been Larry's thing for the last year, is that inflation is higher than everyone thinks. We saw a 50 basis point move higher in the 10-year this week. We saw, a 0.15% move higher in Fed funds. So that's big gap in there. That's not inflation.
Yeah.
Like that's something else going on.
Real yields going up.
Yes.
Basically, the world demanding a higher premium to own them.
Right. In other words, a
if
risk
it's
premium
just
for a
inflation, you'd
riskless
see the
asset.
Fed funds move in conjunction with it. It's a big move, and it's completely reversed. And I think that's what people are watching. The dollar is also the center of the universe right now, always has been. But we are seeing some sharp volatility in selling. I noted the 2% sell-off yesterday. There's a great chart going around the trading desk that shows how bad this week was for the dollar relative to other weeks in history. Look at this. So there's that bottom move, and you can see where outsized terrible week at the very end there for the dollar, comparable
20, right? Yeah.
to other times
22.
we've seen that. Here's just a number to keep in mind: $33 trillion. That's how much U.S. debt and U.S. stocks are owned by foreigners. That's a huge
debt and
number.
stock. That's equity
debt and
and
stock.
yeah,
So it's
right.
about a little more than a third of the U.S. bond market, and a significant chunk of U.S. stocks as well. It just means that when this unwinds, it's a risk. And if you're going to pick a fight with the world on trade, that's a risk. I don't want to be too doomy and gloomy here, but that's what folks in the markets are watching. There's good news today, too. I mean, the good news today is that the real economy heading into all this is doing okay. PPI coming in at the negative number, wholesale inflation negative 0.4%. That was good to see. Credit card spending. Bank of America put out a credit card spending number. They say for the month of March up 2.2%. Retail sales looks good. So consumers are continuing to spend. JP Morgan, CFO this morning on the call talking about retailers and consumers in America, I thought sounded very positive. Listen.
We have seen some of the retailers and other folks talking about weaknesses in the lower income segment. And I think when we look at our card data and also, our cash buffers and people's checking accounts, of course, it is true that it is relatively weaker in the lower income segment. But when you take a step back and you ask, are we seeing signs of distress in the lower income segment? The answer is no. So sure, the margin cash buffers are lower and you see some rotation of spend, and spending is a little bit weaker than it was in the peak spending moments. But actually, some of the increases in spending that we're seeing in April are actually coming from the lower income segment.
Increases in spending in the lower income. Aside from that, I mean, we don't want to see weakness on the low income, but we've heard that on every quarter from retail and banks in the last year and a half. And they said that there's no distress. So, and there's no big, worries out there. I haven't seen it so far from Wells Fargo, JP Morgan. I mean, they're all sounding the alarm that it's out there. But
absent
no
President Trump's decision to engage in a worldwide trade war, I mean, our economy would be in a very good place.
Very good place. And we would be welcoming these negative inflation numbers.
I mean, the interesting thing,
we're talking about a Fed cut,
the
right?
inflation numbers, they're definitely helpful. They're benign. But it is hard to separate the drivers of the downside surprise in inflation from the confidence shock. I mean, the airline tickets going down tremendously in price. That's been one of the drivers. So, I mean, consumer demand cooling off is part of that story. But you're right. Otherwise, it's a pretty favorable setup. And all it tells us is that's the snapshot of the beginning point where we're entering into, these trade frictions. It's the market's trying to sort out. Honestly, I think what the market's trying to sort out is this the moment of maximum, standoff aggression between the U.S. and China? In other words, if anything changes from here, it's going to be de-escalation, but who knows when or how.
But I think the other question to ask is what restores credibility in U.S.
That's
assets,
a big
if anything,
question,
right now? I mean, I don't know. If he fires Navarro, would the market rally on that? If the Fed comes in and says we're gonna watch what's happening on liquidity in the bond market, I mean, these are the kind of discussions that are being had right now.
Yeah, and all weekend we'll continue to, conceivably. All right, let's talk a bit about the equity markets. Of course, it's been a wild week. If you can just see it right there, of course. The S&P is on pace, though, for what would actually be its best weekly performance since November 8th. We're also watching yields. Here was Larry Fink last hour discussing the bond market.
I'm more worried about a much deeper yield curve. And could I see a 5% 10-year? Sure. I don't believe the Federal Reserve will have the ability to do any real easings. I know the forward curves at one time a few days ago was 4 easings, and I said there may not be any easings.
Adam Parker is Trivariate Research founder, CEO, joins us right here at Post 9. What's your week been like? I mean, what do you tell people when they say, all right, how should I view equities right now? What should I do in terms of overall asset allocation?
Look, I mean, we have a database where we download hundreds of things for 3,000 U.S. equities daily back for 25 years, and none of that helps. Okay, so normally we can wrap our arms around it, but I don't have a large sample size of trade wars that I can analyze the subsequent distribution of outcomes. So, look, I think the new thoughts for me this week over week are, one, it's worse now than it was a week ago. To me, the one trade battle that really matters is China, and it looks a little worse today than it did a week ago. It's mark to market. 2, while you might think 10% is better than 25 or 30, it's still bad. It still creates, I think, some price increases and slowing economy. I saw Jamie Dimon just said something that I wrote last week. I agree with that. I think companies are going to remove guides a little bit. So a short-term pair trade strategy might be short stocks that report early in the earnings season, long those that report late in the earnings season. Because
many of these quarters are completely. Who cares? I mean, right. I don't want to overstate it, but we haven't really talked about the bank quarters. It doesn't really matter. It's
all forward. Yeah, we need. I think the market's gotten a little too used to V-shaped recoveries, and we won't get one fundamentally this time. If you think about even last July, all of a sudden every equity guy I talked to was an expert on the Japanese carry trade. It reversed so fast that everyone didn't have to do anything. But go back to COVID, even the financial crisis, the V-shaped recovery came from things I don't think are as likely. Balance sheet expansion. We're kind of doging things. We're not expanding, right? Fed massively accommodative, huge fiscal stimulus, helicopter money, like all that stuff aligned. We got monetary and fiscal stimulus combined, and market ripped. That feels less likely. So I think what you're left with is could a lower oil help? Could maybe the weaker dollar help? I think what Sarah said in the preview, like what fundamentally are we going to see that makes us more bullish? That may take longer. You see the price action. People want anything they can get, but I'm talking about when will companies guide better. I decided this week that my 2026 earnings before are now my 2027 earnings. That seems like a reasonable case. We remove a year of growth. As I was out talking to investors this week, a lot of them thought that was too bullish. A lot of them thought you need to kind of think 25 earnings are going to be down a little bit. And so what I'm really sort of brainstorming now is which companies really will deliver some decent fundamentals here, where I know there's going to be steady demand. Is it healthcare services? Is it, those kind of things where I can get better, estimate achievability, whatever that is for the average company.
What about what's happening in the bond market, as I described?
Yeah.
The selling at a time where equities are nervous, the selling of U.S. bonds, U.S. dollar, U.S. stocks simultaneously.
Yeah.
How can you make a call on equities without knowing what's happening there?
Look, as you know, there's always periods where these asset classes get super correlated. I would take a step back and say I disagree with the end of American exceptionalism logic because I focus on U.S. equities. If I describe to you the themes that I think are going to grow above GDP, whatever that is for the next 5 or 10 years, the U.S. equities over-index to them. It's AI, with the compute. It's AI software. It's power and utilities. It's even U.S. housing where we're low structures and building products. It's life sciences and that whole complex and healthcare services. It's electrification, industrial. So which other countries' equities do you think give you better exposure to that than U.S.? Right. So right now there's a little bit of a trade war and Europe did well. But I think ultimately people come back to what the business is, where the business is the best, and they will be here. And so maybe that's a 6-month, issue because we have to get kind of pick through the python on that tariff stuff. So I'm not a long-term bear on the U.S. on a relative basis in any way because I don't want worse companies in my portfolio for a sustained period.
I just wonder if it's not so
go
much
America, basically.
Not so much that U.S. companies have surrendered their advantage,
right,
but that you have this whole kind of vendor financing scheme we've had going for a really long period of time. Yeah. We're shipping dollars overseas for goods. They're recycling it back into our assets.
Right.
And it implicitly gave U.S. assets a premium.
Yeah.
There was a safety premium. There was a growth premium. There was a stability premium. I don't expect anybody to have a view of like where that takes the S&P PE multiple.
Right.
But maybe it's not 20.
I think it's all related to margins, right? And higher margin businesses trade at higher multiples. We know we can't say, France is cheaper than the U.S., so let's long France. It's cheaper because the companies have lower margins and lower growth. So it all depends on, how much do we hurt the margins of these companies?
We may hurt them a lot.
If we do, then we're going to go to lower multiples, for sure.
Yeah.
And that's a reasonable logic. But I still think even with that adjustment, where we could still cyclically come down, we still have a constitution of companies that are better business models, lower capital intensity, more pricing power globally, et cetera. So it depends, again, on how long this battle lasts. If it's 3.5 more years, then we're going to go back to a multiple that's really low. I don't think that's what most investors are thinking, nor is that, my base case. I think you'll start seeing pressure from a lot of sources in the Republican Party. Hey, we won't give you the tax bill, or, as you saw, wealthy individuals who had better seats than Usha Vance at the inauguration, and other folks might start pressuring. So you can see what happens there. But I think the damage has been done already on confidence. The one thing you said that I sort of don't totally agree with is I think the U.S. consumer was slowing a little bit before the tariff stuff. If you go back to Walmart's guide down earlier in the quarter, I agree it was in good shape, but already eroding a little bit even in early March. If you get the data points that came out of the big conferences in March, things were slowing a little bit.
But not recession.
Not recessionary, but
they were starting to come back a little, actually, in March and April.
I think the general consumer was slowing. I mean, a company like Walmart with their 2% of GDP or whatever their revenue is told you things were lighter. Yeah. And I think it was more than just a little. I think the airline stuff's a little, government specific and other stuff that's going through there. But the real-time travel data is really falling off a cliff. So I think the next thing to get negative on in the pair trade is, first trade is you short the bad companies and consumer, Target and Kohl's and all those kind of things. I think the second phase is there's still a lot of expensive consumer companies out there where people are expecting decent growth and they're not going to deliver. So why is Chipotle deserve to trade at 37 times earnings if they don't grow double digits, or Hyatt or Wingstop or Carvana? Like, you can go down the list and find a lot of short ideas heading into earnings.
Adam, we got to end there. Thank you.
Yeah, always good to see you guys. Yeah, be well.
Always good to see you too, Adam Parker.
As we head to break, here's our roadmap for the rest of the hour. A flood of big bank earnings out today. What the latest results and commentary are saying about the health of financials and the whole system.
Plus, a wild week of trading for the Mag 7 names. We'll take a closer look and tell you about some big analyst calls within the group.
And retail investors still buying despite this dramatic volatility. Well, where's their money going in this market? We got a big show for you straight ahead. Don't go anywhere.
Insurance.
Bank stocks moving in opposite directions, at least. JP Morgan, as you see, the name that's up. We got Wells, Morgan Stanley as well. Another earnings season for the group. Of course, we get more next week. Leslie Picker tracks all of them, can fill us in on both the earnings, and I guess we've also had some conference calls as well. Leslie.
Yes, in the middle of those, David, a very mixed response this morning, perhaps a reflection of the continued uncertainty that's out there. Despite decent first quarter numbers and stable outlooks, the earnings call, as I mentioned, for the three underway. Nearly every analyst question on the JP Morgan call this morning encompassed some kind of macro question, unsurprisingly. Chairman and CEO Jamie Dimon said many of the issues will be resolved for better or for worse in the next 4 months, but Dimon reiterated his belief that geopolitical risk is paramount.
Most important thing to me is the Western world stays together economically, when we get through all this, and militarily, to keep the world safe and free for democracy. That is the most important thing. I really almost don't care fundamentally about what the economy does in the next 2 quarters. That isn't that important. We'll get through that. We've had recessions before and all that. It's the ultimate outcome. What's the goal? How can we get there? And it's literally that.
Now, any major recession concerns not yet baked into this morning's earnings reports. Guidance on net interest income, that's the profitability metric for loan making, was unchanged at Wells Fargo, slightly higher actually at JP Morgan for the year. However, JP Morgan did set aside nearly $1 billion more for reserves, which it said was driven in part by changes in the macro outlook. For JP Morgan and Morgan Stanley, revenue growth was largely driven by equity trading, which saw more than 45% jump at each of those firms. I spoke earlier with Morgan Stanley CFO Sharon Yeshaya, who said they saw an increase in client balances and higher activity associated with the tremendous volatility in the first quarter, especially in derivative products, guys.
Have you heard anything, Leslie, about, I played a little bit of a soundbite from JP Morgan CFO, not seeing a lot of distress with the consumers, but just, the fact that we have credit risk rising, banks usually have a pretty good idea of what's happening on the credit side. It's been really strong. What do they expect?
Yeah, I actually, it's funny you mentioned that. I heard that soundbite that you played, and there's another one from this morning, the Wells Fargo call, where they talked about the consumer, and Charlie Scharf, the CEO there, says, I was just pulling that up real quickly, that their internal indicators continue to point toward the strength of our consumers' financial position. I was interested in hearing that. Consumers have remained resilient, and debit and credit card spending patterns have remained stable. An interesting thing also that we heard on the JP Morgan call from CFO Jeremy Barnum was this idea that a lot of the spending patterns they think are attributed to some of the pull forward effects where consumers are trying to buy things in anticipation of rising prices down the road, which I thought was a pretty interesting marker given what we're seeing with regard to the macro picture.
For sure, Leslie. Did anybody get questions, or was there any talk about the extreme kind of financial market stress that we see currently? It's obviously not from first quarter numbers, but references to extreme volatility and what that means for derivative product flows. That's one thing. But in terms of whether the banks like JP Morgan and Morgan Stanley are seeing anything that looks a little bit shaky.
Yeah, that was definitely a question that was on the JP Morgan call, asked to Jamie Dimon, who talked about the Treasury market in particular, and he predicted that ultimately the Fed will step in there. He said based on rules and regulations, I'm not sure which rules and regulations he was referring to on that front. He said they don't have a need to at this point in time, but predicts that ultimately they will need to step in.
Well, that's pretty interesting. Guess the market's going to test that. 4.55 on the 10-year right now, heading north. Thank you, Leslie.
You got
Leslie Picker was below 4%.
I know.
Last week after Liberation
we were
Day.
right, 3.8, right?
Yes.
That's our low.
Major averages are lower again right now, but on pace actually to end the week in the green. S&P and NASDAQ for their best week, in fact, since November and September of last year, respectively. Biggest gainers on the S&P, Newmont. That's the gold trade. Gold is working today with the dollar under pressure. More on the movers to watch after a quick break.
Universal Orlando Resort.
Welcome back to Squawk on the Street. I'm Silvana Hanal with your CNBC News update. The Kremlin says President Vladimir Putin will hold talks today with President Trump's envoy Steve Witkoff in Russia. A spokesperson said the two could discuss a future meeting between Putin and President Trump and warned Witkoff's meeting would not produce any breakthroughs. Witkoff has been pressuring Russia to accept a ceasefire with Ukraine. Meanwhile, European countries vowed today to send billions of dollars in further funding to help Kyiv fight Russia's invasion. During a meeting in Brussels of defense allies, the British Defense Secretary said the new pledges amounted to more than $24 billion. And Publishers Clearinghouse, known for its big prize checks, has filed for Chapter 11 bankruptcy. The marketing and sweepstakes company said in an announcement this week it was trying to move to a pure digital advertising model. And this filing comes as Publishers Clearinghouse has struggled with rising operational costs and changing consumer habits. David.
Thank you, Silvana. All right, let's get over to Dom Chu. He's also at headquarters. Got some of the key movers for us so far this morning. Dom.
All right, so as we talk about the week that was and what's happened since Liberation Day, let's kind of give you some focus here and perspective on just how far we come with the major indices. If you look at the S&P, the Dow, and the NASDAQ, since Liberation Day last week on the 2nd, the close there, the Dow is still down about 6%, 7% for the S&P 500, and the NASDAQ is down 6.5%, so fairly even across the major indices. If you take a look at the big part of that, the Mag 7, in terms of market cap losses since that Liberation Day, Apple, $502 billion, Microsoft, NVIDIA, Amazon, Alphabet, Meta, and Tesla, you can see have all shed market value here, but well off what they were earlier this week at some of the lows in the market. At that point, total here, we got about roughly $900 billion worth of losses total. That was closer to 1.8 trillion earlier this week, so keep an eye on that. And then as we talk a little bit more about some of the moves that we were seeing within the sectors and everything else, NVIDIA comes to mind. We got a target price cut over at Citi to $150 a share from 163. That's keeping the buy rating. They're doing that mostly on valuations based upon assumptions of fewer chips, GPUs, being sold in the future. So NVIDIA shares up about 1.25%, a key part of the focus. And one last point, Mike, to kind of put an end on this. The 1 week chart in terms of the S&P 500 sectors, you take a look at technology and communication services. Those are the ones that have gained the most in the past week. Energy has been the biggest decliner. It continues a trend, of, so to speak, right? So, Mike, keep an eye on those sectors. I'll send things back over to you.
Yeah, pretty much a reverse of probably the prior week in terms of winners and losers. Dom, thank you. Speaking of movers, a few names hitting fresh 52-week lows, about 125 actually on either the NASDAQ or the New York Stock Exchange. But Chevron and Texas Instruments are among them, both down. Plus, Goldman raising the firm's recession odds, then walking it back an hour later as the trade volatility continues. Their chief U.S. economist joins us next. We're back in a moment.
You download Dave.
About an hour into trading of the final day of the trading week. Dow, S&P, and NASDAQ all lower right now. We've been lower, higher, and now back down again. But we are on pace to end higher on the week since Monday, thanks to that big rebound we saw with the pause on the tariffs for countries outside of China. Here are three big movers we're watching right now. Bonds, front and center, rising. Yields right now after a volatile week. Tech is the best performing sector on the week. Names like Broadcom leading the charge, but a number of chip names up double digits. Watch divergence in the dollar and gold, headed in opposite directions as usual, but really sharp moves here with the U.S. dollar hitting multi-year lows as we speak. Gold hitting an all-time high this morning. So there's that alternative to the U.S. dollar. Bitcoin also holding up pretty well.
Yeah, Bitcoin is another potential refuge, I guess. Mike, what are you keeping an eye on?
I mean, watching to see the equity market, first of all, it's just fibrillating here. It's flopping around in the range we've been in for the last couple of days, but trying to withstand 10-year Treasury yields going above where they were 2 days ago when it seems like it met a threshold for the president essentially trying to come out and saying they're pausing the reciprocal so-called tariffs on most of the country. So are we trying to make our peace with yields at this level, or if equities did they get so washed out? Yesterday's range in the S&P was 6.5%. And it was within the prior day's range, right? So that shows you that the market just has to whip all over the place to find conviction. And it's the markets testing the White House, and the White House kind of perhaps wondering what the markets will accept. And that's an uncomfortable spot.
Is my question. That's what I keep coming back to.
Well, I think until one, there's an actual deal, as they describe it, that is unveiled. The market recognizes
with any
another country.
Another country, not China, any one country.
I mean, whatever you want.
Don't you think that's priced in? The market expects deals with Japan and Korea and Vietnam.
I think there is. I think every day we walk in and there's a certain probability of a deal headline in the market. The more hours that go on, we don't get one. Maybe the value of that option erodes, and then the market. That's why we're trading this way. It's like in the pandemic when we were trading like the second derivative of new cases. I mean, it's kind of crazy in that way. It doesn't make a lot of sense in terms of long-term money being whipped around this way in such a short period of time. No. But this is the reality of a 45 VIX market, where, by the way, it should be there because that's how crazy the tape has been.
For the 10-year, though, which we've been focused on appropriately so now for quite a few days. I mean, you mentioned earlier the potential selling that's taking place. Are they going to ever come back? I mean, do we have any sense as to what they're looking for in terms of saying,
no, that's why I keep raising it, right? What restores confidence? I mean, a move by the Fed to intervene would do so, to push back.
Would it? I even wonder about that.
There's a lot of firepower there.
Would it? There's a lot of firepower, but it might also increase concern in a certain area.
I mean, that's usual. That can. I mean, go back to financial crisis when there's intervention in the U.S. central bank, the most powerful central bank. That usually can help, no doubt about it. But I think the longer term questions about what restores credibility and confidence in the U.S. as an asset, whether you buy into it or not. Like, I agree, Adam Parker, you can say the U.S. still has the best companies in the world and we still are exceptional. But if foreigners and other central banks are selling, then that leads to questions about dollar reserve. And the best thing we have from the dollar reserve is lower interest rates.
That's right. But if we think about it as the rest of the world essentially just reducing its overweight exposure to the U.S., at some point it gets to an equilibrium where it's not like they're going to go to zero.
Well, they got nowhere else to go either. I mean,
That's part of it.
You need an alternative.
We talked about it. German bond market is a fraction.
Right, it's a fraction.
China's not an open market. No. So there isn't much of an alternative, but it still is an unwind of a trade that's been very popular, an investment in the U.S. So President Trump's trade war is sending markets on a wild ride this week. BlackRock's CEO Larry Fink speaking with us in the past hour about the uncertain environment right now. Here's how he characterizes it.
This is not a pandemic. This is not a financial crisis. This is something that we've created. As I said also on Monday, the United States post-World War II was a global stabilizer. We are the global destabilizer. And that's a very hard thing to say, because I pride ourselves of being, bringing the leadership, bringing the conversations. But I will say the power of U.S. capitalism is still alive. I will say more and more times clients worldwide are asking for our, at least at the CEO level, they're asking for our vision, our views. They still want to engage. They still want to build. So I'm long term, I'm less worried about some of these issues. But in the short run, I'm petrified at some of these issues.
Using the word petrified.
Yeah.
I think. I mean, it sums up.
It's that dichotomy,
right.
Long term, and again, he's a believer in capitalism, of course,
Sure.
but short term, well, you heard it. I don't have to say
I think
again.
the geopolitical risk, it's something that Fink is talking about here. It's something JP Morgan's Jamie Dimon talked about. Let's dive into the macroeconomic view, recession odds. David Miracle, Goldman Sachs chief U.S. economist, joins us here. David, we watched your research team this week, I think on Wednesday, go from recession to not recession in one day. Many of the other investment banks kept their call. Why did you change it so sharply?
We moved our forecast to a recession when the country-specific additional components of the reciprocal tariff came on. That would have raised the U.S.'s effective tariff rate quite substantially. When those were taken away, we went back to a still high 45% probability of recession, but it's not anymore a base case. It's not just that the additional tariffs would have been very large, so that all of their effect is effectively a tax hike, the effect on business confidence and all of that is a little bit smaller now that the tariffs are smaller. It was also that a maximalist approach from the U.S. would probably have invited even more aggressive foreign retaliation, and that the tariffs were very large on some other regional Asian economies that Chinese trade has been rerouted through. So that large tariff on China would have had more impact if you can't just reroute, say, through Vietnam.
So now what we're left with is a bunch of other tariffs, but the biggie is the U.S. and China. How will that impact the U.S. economy if trade shuts down between the U.S. and China if these sky-high tariff rates stick?
Well, I would say actually it's quite a bit more than just the U.S.-China. We have a 10% floor on everybody else. We had a bunch of tariffs that were already in place, and we still think a large tariff on so-called critical imports is coming. All of this adds up to an increase in the U.S.'s tariff rate that we think will be 10 times at least what you saw during the 2019 trade war. So the U.S.-China tariff, by far the largest, I think that will shut down a fair amount, although not all trade flows between the two countries. If a consumer good that we import from China, if only a small, moderate share of the final consumer price actually consists of the import cost, then maybe some companies will still continue to do that. But with such a large tariff differential between China and other countries, I think we are effectively setting up a huge incentive for Chinese companies to ship goods through other countries, or to take advantage of production networks that they've established over the last 5-6 years that involve other countries where the finishing is done there. So that will be something that presumably the White House won't like, and we'll have to see how that gets resolved. But at the moment, there's a very large incentive to do that.
Are you guys on Fed intervention watch?
We are. We're still expecting under our 45% probability of recession forecast with 0.5% GDP growth this year, a modest uptick in the unemployment rate, about half a point. We think that would be commensurate with a package of 3 25 basis point insurance cuts. So we have those penciled in for June, July, and September. I think it's going to take a little bit of time before we get hard economic data that makes a case that things are getting worse. For example, we just got a payrolls report. The payrolls for April, being collected right now. I doubt we're seeing large layoffs right now. So the soonest we would see that's probably the May data in early June. In the meantime, the Fed's going to have to make a judgment call about our financial market conditions and the decline that we see. We just saw a moment ago in survey data, in the Michigan survey, for example, or in business surveys. Is that enough to justify a cut? It's possible, but we think more likely starting point would be June.
Half a point on the upside in the unemployment rate. So do you think that on the way there, the Fed decides that's clearance to do something?
I think that's right. I think with inflation high and inflation expectations now strikingly high, the bar to cut will certainly be higher than it was in 2019.
Well, inflation expectations in survey data, not necessarily in market
Absolutely.
pricing.
And Fed officials have taken some solace from that. And as we heard Chair Powell say at the March meeting, he's not that worried that this will become a persistent source of high inflation. So that if we do see the unemployment rate trending higher, I think they will feel at liberty to cut. I would say this raises the bar, but it's not prohibitive for cuts.
All right, David, thank you for joining us, bringing us up to speed on your views. David Miracle from Goldman Sachs.
All right, big banks, of course, moving most down, but J.P. Morgan, the exception, of course, as this after we did get earnings from those three names you're looking at right there. Also, Wells Fargo's conference call is underway. We'll get the headlines after a quick break.
Wells Fargo's conference call currently underway. Leslie Picker back to give us some key headlines so far. Leslie.
Hey, Mike. Yeah, Wells Fargo, the biggest laggard of the three banks reporting today. Despite the macro uncertainty out there, Wells Fargo held firm on its net interest income guidance. That's the profitability metric for loan making. However, CEO Charlie Scharf noting on the conference call that there are, quote, huge unknowns, pointing to changes in the yield curve that is changing not just by the day, but also in many cases by the hour.
We have heard a great deal from our clients as they work through this transitionary environment. We have not seen an impact on their condition yet. This is a complicated issue, and it is our current expectation that we will face continued volatility and uncertainty and are prepared for a slower economic environment in 2025. But the actual outcome will be dependent on the results and timing of policy changes.
Executives on the call saying that the consumer is in good shape and they haven't seen deterioration happen in any meaningful way. The same is the case on the corporate side. The only place with, quote, systemic stress is still the office portfolio, but they did note it's been pretty stable, guys.
Okay, Leslie, thank you for the update. And a whole lot more on Wells Fargo next hour. We're going to be talking to the CFO post-conference call. That is in 11 a.m. hour of Money Movers. More Squawk on the Street coming right up with the Dow down 48 now. We'll be right back.
Insurance.
Stocks on pace after all that for a positive week as Main Street keeps buying the dip. Kate Rooney here with some new numbers on retail investors. Kate, what do you see?
Yeah, Sarah, so individual investors are still willing to step in to that volatility you talked about and buy the dip at this point. Retail activity broke records last week. The buying remains right now what Vanda Research at least calls robust. As JP Morgan put it, this week investors have been willing to place confidence on the market upside despite radical policy uncertainty. That did pay off at least on Wednesday with some of that tariff relief. Also, that post by President Trump with saying this is a great time to buy. At the close of that day, average retail portfolios were up 17%. That's according to JP Morgan. S&P at that same time had the biggest one-day gains since 2008. Much of that, of course, has reversed. And as of the close on Wednesday, retail investors did start to lock in some of the gains that they've seen, selling single stocks and then buying the dip. Kind of just moved to ETFs. Vanda Research says that does suggest some longer-term broad bets on equities. Vanguard's S&P ETF is right now among some of the top traded names. And then if you look at where the money is going right now, it is mostly NVIDIA, consistently the most actively traded stock. Of the $3.5 billion that went into single stocks for one day this week, $3 billion of that, to put it in context, went into NVIDIA alone. So other retail favorites like Tesla, it's been a little bit more mixed on the sentiment. There has been some hedging. Seen the SQQQ jump. The YOLO trading crowd, as we talked about yesterday, though, still alive and well. There's a risky leveraged Tesla ETF and then one that gives you double exposure to the NASDAQ 100. Those are still among the most actively traded names, guys, at least on Fidelity. David, back to you.
Wow. Yeah, those are day trades, a lot of them, I would guess. Yeah. Kate, thank you. Kate Rooney. Speaking of day and the trading, we've got the S&P in negative territory, not by much. Let's call the NASDAQ. I'm going to call it flat right now, of course, but it has already been a volatile session. We've got a lot more for you straight ahead in Money Movers.
Now.
Good Friday morning again. Welcome to Money Movers. I'm Sarah Eisen with David Faye.